I'm John Foley, an advisor with IMFG, and I'm joined today by Steve Garth, who sits on our investment committee. Steve, it's been quite a quarter. We've seen interest rate changes, we've seen inflation spike, and a war in Ukraine. How's that impacted markets?
Yeah, it has been a very volatile period, John, and I'm going to start off by talking about the bond market because that's what everyone's talking about at the moment. If you have a look at this chart here, you'll see that the yield, the 10-year Australian government yield, have been rising rapidly. Now that's got to do both with inflation and interest rates. It's the bond market pricing in their expectations of future rate rises and where inflation will end up. But in the bond world, when yields go up, prices go down, and you can see there that we're looking at the return of the Australian bond market. It's the worst quarterly return on record.
Well, let's come back to bonds, but how about the equity markets in the past quarter?
Yeah, well, let's start with Australia, John. And once again, we used the word roller coaster before. You know, it was the worst January in the Australian market since the GFC way back in 2008. But the market's recovered quite strongly and has got a positive return of 2.2%. Now, the reason for that positive return is that Australia, as you know, is really made up of banks and mining. And guess what? Banks do well when interest rates are going up, and miners do well when commodities go up in price, and that's what's been going up.
So that's the Australian share market. What about other equity markets?
Yeah, I did mention that the Australian equity market defied gravity when every other market around the world was negative. And it really has got to do with the fact that we've got financials and materials, but we've got a very small tech sector. It's the tech stocks that really got beaten around in January. They were really in correction territory. So by tech stocks, we really mean those big tech companies like Apple, Google, Facebook, Amazon. They were down a lot. Now, they too have recovered a lot in the last 2 weeks. Bizarrely, John, the recovery started when the interest rates were actually formally put up on March the 16th by the Fed.
So there's a lot of uncertainty out there, Steve. And normally in times of war, there's a flight to safety and defensive assets, and bonds usually do well. But that hasn't happened this time.
That is right, John. And I think what the market are looking at here, they're looking through the conflict in Ukraine, and they're looking more towards inflation. And so the bond yields are going up and bond prices are going down because of this spike in inflation. But we should say that even though interest rates are going up, we know interest rates are going up, it doesn't mean that the yields will keep going up. In the chart here, I'm showing you the yield curve of the Australian bond market. And you can certainly see that that top curve is the current yield curve, and you can see how high it's jumped in the quarter. That's the market pricing in their expectations around interest rates and inflation. So when interest rates do go up, it may not mean that the yields go up. The yields might have already priced that in. But yes, the bond market is looking through the war in Ukraine, and it's looking more at inflation in the future.
Thanks very much for that, Steve. And thank you for joining us. We look forward to welcoming you back in July for our next quarterly market update.